Before we get into why we're listening to Warren Buffett, it's important to realize the entire paradigm is changing. This is the price of silver since 2010. Silver is an essential aspect in developing AI data centers. That's why we are seeing its price grew to $60 per ounce. It is up 60.7% so far this year alone. However, when compared with TSMC stock, Taiwan Semiconductor Manufacturing Company, we see an insanely high correlation, as the lines basically click in since 2020, when semiconductors were being developed with regard for AI. Silver and TSMC stopped being loosely related commodities and equities. We now see they've become expressions of the same industrial cycle. Since around 2020, they've effectively been pricing the same thing from two different angles. TSMC prices the brains of the AI economy. Silver prices the nervous system. Pre-2020, silver traded like a mixed-use metal. Post-2020, it trades like infrastructure. It's also heavily used in electric vehicles, as they use materially more silver than internal combustion cars, especially in power electronics and battery systems. Unlike autos of the past, this demand doesn't normalize downward with efficiency, but instead it scales with volume. This is why we think silver is trading like a strategic input and not a hedge. Keep in mind, firms like Nvidia do not produce chips by themselves. Everything gets built by TSMC. Every AI chip that actually exists in the world goes through TSMC. This is why we're listening to Warren Buffett. We are in the midst of an AI revolution, and many experts believe that AI could have a profound impact on our jobs. Recent studies showed that AI can already automate 57% of all US work hours. In practice, this could mean what now takes 6 people to do would soon require only 2 or 1. Amazon recently said automation could avoid hiring roughly 160,000 warehouse workers by 2027 and gradually replace tasks across as many as 600,000 roles over time. We're seeing Warren Buffett has recently argued that Americans should not fear automation because technological change has repeatedly strengthened the economy over time rather than destroying it. He points out that while new technologies often eliminate specific jobs, they also increase productivity, lower costs, and create entirely new industries that employ even more people. In Buffett's view, this process has played out many times in U.S. history, and the overall result has been rising living standards and sustained employment, even as the nature of work changes. To illustrate this, Buffett uses the example of the tractor replacing manual farm labor. Before mechanization, a large portion of Americans worked in agriculture, but the introduction of tractors dramatically reduced the need for farm workers. Despite this massive loss of farm jobs, the economy adapted. Workers moved into manufacturing, services, and other emerging sectors. Buffett believes that automation today follows the same pattern. While it disrupts certain jobs in the short term, the economy finds ways to re-employ people in new roles, allowing economic growth to continue. From an investing point of view, Buffett is a value investor. His strategy allowed him to generate superior profits, even during times when most assets were declining. We've recently seen Buffett revealing $4.3 billion stake in Alphabet, a parent company of Google, as it trims Apple holdings. Take a look at this chart, which shows an employment-to-population ratio. Since the beginning of this century, there was in fact a trend to outsource jobs and implement new technology as well. We've seen a drop from 64% in 1999 to the current 59% of the population employed. This trend, as you see, hasn't really been broken, and we're following precisely this trend line. The 2008 crisis caused a sharp drop that took a long time to get back to, but the trend really remains unbroken, and we're seeing AI only contributing to this further. While Buffett's saying automation won't cause major drops, we still think there is a space for the percentage of employed population to drop. As you see, from 1950 to 2008, the trend line for employment level followed an exponential pattern. However, this pattern detached after 2008. Before 2008, we've seen strong cyclical recoveries. Employment to population returns to or exceeds its prior highs. After 2008, it never fully recovers, even during a decade-long expansion. If a smaller share of the population is working, then total employment cannot return to its long-term exponential path. In its simplest form, the economic cycle does start with people being productively employed. Individuals produce value, earn income, then spend this income, consume goods and services, generate revenue for firms, and that revenue allows firms to hire more workers and invest. This loop is essentially the Keynesian circular flow of income, and it explains why widespread employment is so powerful for sustaining growth. When many people have paychecks, consumption is broad-based, demand is stable, and companies have confidence to expand. Where it gets more nuanced, and where today's AI and automation debate comes in, is that employment does not have to grow one-for-one with production anymore. Technology allows firms to increase output and profits while hiring fewer people. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenaius.